Welcome to the deep dive. We've got quite a few materials you sent over, all focusing on how external auditors, interact with the work internal auditors do.
Yeah,
Think of this as us kind of wading through that for you,
hmm
pulling out what's really essential, giving you a quicker path to understanding this specific area.
exactly. We're aiming to cut straight to the chase, especially looking at ISO 610, revised 2013, using the work of internal auditors. You probably saw how it's laid out: intro, requirements, and then more explanation.
Right.
Our mission here is really just to pull out those core ideas, the procedures governing this relationship, and what it all means for audit quality and efficiency.
Okay, sounds good. So where should we start? Maybe the scope of ISO 610. When does it actually, kick in?
Good question. Fundamentally, ISA 16 applies when an external auditor is thinking about using the work done by the company's internal audit function, using it as part of their own audit evidence. But, and this is basic but important, if the company doesn't have an internal audit function,
Mhm.
well, then the standard doesn't apply. It's kind of a non-starter in that case.
Right, that makes sense. No internal audit, no ISA 610 issues there.
Precisely. And another key thing, even if there is an internal audit team, ISA 610 only really matters if the external auditor plans to use their work.
Ah, so they don't have to use it.
Not at all. The external auditor can always choose to do everything themselves, completely independently. The choice is theirs.
So just because the function exists doesn't mean its work automatically gets folded into the external audit.
Nope. It depends on the external auditor's evaluation, which we'll definitely get into. There's also another potential hurdle right at the beginning.
Oh, what's that?
Sometimes local laws or regulations might actually restrict or even completely prohibit the external auditor from using internal audit work.
Really? So that could stop things before they even start.
It could, yeah. It's something they need to check up front.
Okay, that's a critical first check. Now, I remember seeing something about ISA 315 being connected to this. How do they fit together?
Yeah, good point. Understanding the internal audit function is actually part of the external auditor's bigger job under ISA 315 revised.
Which is about risk assessment.
Exactly. ISA 315 is all about identifying and assessing the risks of material misstatement. So as part of that, the external auditor needs to get a handle on the internal audit function.
Like what they do, who they report to, that kind of stuff.
Precisely. Their nature, their status in the company, the scope of their work, what resources they have, the activities they actually perform.
And understanding that helps the external auditor with their own risk assessment.
Yeah, it feeds into identifying and assessing those risks of material misstatement. And this is absolutely critical. Even after they've done all that groundwork, the external auditor still develops their overall audit strategy independently.
So having an internal audit function doesn't change the external auditor's basic responsibility.
Not one bit. It doesn't lessen their obligation to plan and perform an audit that gives them a solid basis for their final opinion.
Which really drives home the point about who's ultimately responsible, doesn't it?
Absolutely. The standard is crystal clear here. The external auditor has sole responsibility for the audit opinion, period.
And using internal audit work doesn't change that.
Doesn't reduce it at all. Even if they use internal audit work quite a bit or even get direct assistance, the buck stops entirely with the external auditor.
That's a crucial point for maintaining independence and credibility.
Yeah.
Okay, so bearing that in mind, what are the specific objectives of ISA 610? What's it trying to achieve?
Well, there are basically three main goals. First, to figure out if the work of the internal audit function can even be used for the audit. And that involves evaluating them, which we'll talk about.
Okay, step one. Can we use it?
Step two, if the answer is yes, then determine how much of that work can be used and in which areas.
Right, the extent of reliance.
And third, to determine if internal auditors can be used to provide what's called direct assistance. That means working directly under the external auditor's supervision and review.
Okay, so can we use their past work? How much? And can they help us directly with our tasks? That seems like a logical flow.
It is.
Before we dig into that evaluation part, are there key definitions we should quickly cover?
Yes, definitely. Two main ones. First, internal audit function. The standard defines it as an activity providing assurance and consulting designed to evaluate and improve how effective the entity's governance, risk management, and internal controls are.
So it's quite broad, focused on improving the organization internally.
Pretty broad, yeah. It can cover a lot of ground. The second key term is direct assistance.
Which you just mentioned.
Right. And that specifically means using internal auditors to perform audit procedures, but under the external auditor's direction, supervision, and review.
Got it. So a clear difference between relying on stuff they've already done versus having them do specific tasks for the external team. Okay, let's tackle that first decision then. How does the external auditor decide if they can even use the existing work of the internal auditors? What are they looking for?
Right. This initial evaluation is key. They need to assess three main things about the internal audit function. First is objectivity.
Independence, essentially.
Yeah, pretty much. To what extent does the internal audit function's position in the company, its policies, its procedures, support the objectivity of the individual internal auditors?
Like, who do they report to?
Exactly. Does the reporting line allow them to be objective? Ideally, they'd report to the highest level of governance, like the audit committee, not the management they might be auditing. And are there policies to manage conflicts of interest?
Okay, so a strong reporting line and clear conflict rules are good signs for objectivity. What's the second factor?
Competence. Does the internal audit function have the necessary knowledge, skills, and abilities to do their work reliably?
So are they qualified? Do they have the right expertise?
Uh-huh. Looking at qualifications, certifications, experience, ongoing training, all that feeds into assessing competence.
Makes sense. You need competent people. And the third element.
The third is whether the function applies a systematic and disciplined approach. This includes having, quality control procedures.
Meaning, do they have proper planning, methodologies, documentation standards? Is there a quality review process for their own work?
Exactly. It's about having a structured professional approach, not just ad hoc reviews. Is there rigor and consistency?
So objectivity, competence, and a systematic approach. If the external auditor is happy with those three, what's next? How do they decide how much to rely on the work?
Okay, so if they pass that initial hurdle, then the external auditor figures out which specific areas and how much they can actually use the internal audit work that's already done.
And how do I make that call?
Well, a few things come into play. One is just the nature and scope of the specific work internal audit did. What exactly did they look at? How deeply? Is it relevant to the external audit?
Right. So if internal audit did a detailed test of controls in area X, the external auditor would look closely at that work.
Precisely. Then a really big factor is the external auditor's own assessment of the risk of material misstatement for that particular area or assertion.
Ah, so higher risk means less reliance.
Generally, yes. If the external auditor sees a high risk of misstatement in a certain area, they're probably going to rely less on internal audit's work there and do more testing themselves.
And conversely, lower risk might allow for more reliance.
Potentially, yes. It's a risk-based judgment.
Okay. What else influences the extent of reliance?
The degree of subjectivity involved.
Subjectivity, meaning how much judgment is required.
Exactly. If evaluating the audit evidence involves a lot of judgment, complex estimates, subjective assessments, the external auditor will likely want more direct involvement and rely less on internal audit.
So something straightforward, like maybe confirming bank balances, might be easier to rely on than, say, internal audit's review of a really complex impairment calculation.
That's a good example, yeah. The more subjective, the more the external auditor typically needs to do themselves.
Okay, so let's say they've decided they can use some work, and how much. What does the external auditor actually have to do when using it?
Well, first, they need to actually read the relevant internal audit reports, understand what they found.
Makes sense.
And they need to discuss any significant findings with management and also with the internal auditors themselves. Get the full picture.
So communication is key.
Absolutely. And then crucially, the external auditor has to perform sufficient audit procedures on the specific internal audit work they plan to use.
To check if it's adequate for their own purposes.
Exactly. They need to satisfy themselves that the work internal audit did is reliable enough and suitable for the external audit.
And the amount of checking they do depends on those factors we discussed. Risk, subjectivity, the initial evaluation.
Precisely. Higher risk, more subjectivity, maybe some initial concerns about competence or objectivity. All that would likely lead to the external auditor doing more procedures on the internal audit work itself.
So it's definitely not just taking their report and running with it. There's a layer of verification.
A necessary layer of verification, yes.
Okay. Now let's switch gears to that direct assistance idea. When can internal auditors actually help the external team directly?
Right. Well, the absolute first check is it even allowed? Some laws or regulations might flat out forbid it.
Ah, back to the legal checks.
Always. Assuming it is permitted, the external auditor then needs to evaluate the specific internal auditors who would be providing the help.
Evaluate their objectivity and competence again.
Yes, similar evaluation, but focused on the individuals involved. And based on that assessment, the external auditor decides how much supervision they'll need to provide.
So if there are maybe some minor concerns about objectivity, or if the person is less experienced, the external auditor would supervise more closely.
Exactly. More perceived risk requires more direct oversight.
Are there things internal auditors can't do, even under direct assistance?
Yes, very important limitations. To protect the external auditor's judgment, internal auditors should not be used for direct assistance on tasks involving significant judgment in the audit.
Like making key accounting estimates or assessing complex risks?
Correct. Also, not for areas with a higher assessed risk of material misstatement where the external auditor's judgment is paramount. And not for tasks that involve interpreting tricky laws, regulations, or accounting standards.
So keep them away from the really high-stakes judgment calls and interpretations.
That's the idea. It protects the integrity and independence of the external auditor's opinion. Direct assistance is generally better suited for more defined, less subjective procedures.
Understood. So if they do use direct assistance, what are the external auditor's responsibilities in managing that?
Okay, several key things. First, they need to get a written agreement from management
Agreement about what?
that the internal auditors providing assistance will follow the external auditor's instructions, and crucially, that management won't intervene or interfere with that specific work.
Ah, so it confirms the external auditor is in charge for those tasks.
Exactly. Reinforces their direction. Second, they also need a written agreement from the internal auditors themselves.
What's in that agreement?
Confirmation that they'll keep audit matters confidential, follow instructions, and importantly, that they'll immediately tell the external auditor if any threats to their own objectivity pop up during the work.
Okay, so clear lines of communication and expectations set for everyone. What else?
Then comes the actual management. The external auditor has to direct, supervise, and review the work done by the internal auditors. The level of this needs to be appropriate, considering their assessment of the individuals and the task.
Constant oversight.
Appropriate oversight, yes. And finally, the external auditor must perform enough of their own procedures to be satisfied that the work done via direct assistance was performed adequately. It loops back to their overall responsibility.
Right. Even with help, they own the final outcome and need to ensure the quality. This whole process, both using prior work and direct assistance, sounds like it needs solid documentation.
Absolutely. Documentation is critical. The external auditor needs to document their evaluation of the internal audit function's objectivity, competence, and systematic approach.
Their initial assessment.
Yes. And they need to document the nature and extent of the internal audit work they actually used and what procedures they performed on that work to deem it adequate.
Okay. And for direct assistance?
For direct assistance, they need to document their evaluation of the individual's objectivity and competence. Also, the basis for deciding the level of direction, supervision, and review they apply.
In the actual work done.
Yes. What work was performed, who performed it, which internal auditor, who reviewed it from the external team, and the dates. It needs to be a clear trail showing what happened and how it was managed.
Okay, this gives a really thorough view. It seems the big takeaway is that while external auditors can leverage internal audit resources, it's done very carefully with lots of evaluation, and the external auditor never, ever gives up responsibility.
That sums it up perfectly. ISA 610 provides a clear framework for making those judgments. Can we use them? How much? Can they assist directly? But always ensuring the external audit's integrity comes first.
So for you listening, grasping these principles really sheds light on the checks and balances within the audit process. It shows the care external auditors take when deciding whether and how to use internal audit work, all aimed at trustworthy financial reports.
Which kind of leads to a final thought, doesn't it? Thinking ahead. Businesses are getting more complex, regulations keep changing. How might this interaction between internal and external auditors need to shift or evolve in the future? To keep improving audit quality and maybe find more efficiencies.
That's a really interesting question to ponder. How will this relationship adapt going forward? Something for you all to think about.